Welcome back to The Market Man. Today we're diving into a story that could reshape the global economy, the new USA-China tariff deal. After years of tension, tariffs, trade wars, supply chain battles, and geopolitical power moves, the world's two biggest economies have finally agreed to a new trade framework. But nothing is ever simple. This deal is more than just tariffs. It's strategy, influence, currency power, and global competition. And today, we decode it all, Market Man style. Let's get started. How we got here. For nearly a decade, the United States and China have been locked in constant trade battles. From steel tariffs to semiconductor bans, from supply chain slowdowns to global inflation spikes. Both sides have felt the pressure. The U.S. wanted fairer trade, reduced dependencies, and stronger technology control. China wanted market stability, export growth, and freedom from weaponized tariffs. And yet, both economies needed each other. Why this deal happened now? So why now? Why 2025? Three reasons: economic pressure, global competition, and political timing. Reason number one: slowing growth. Both nations faced slowing GDP, rising manufacturing costs, and pressure from multinational companies seeking stability. Reason number two: global competition. Rising India, Vietnam, Mexico, and Indonesia have grabbed massive market share. The longer the U.S.-China tension continued, the more both giants risked losing power. Reason number three: political timing. Both governments needed a win, something that helps exporters, investors, and voters. What's inside the tariff deal? Let's break it down simply. Here are the major elements agreed upon. Reduced tariffs on consumer electronics and industrial machinery. This helps both exporters and lowers inflation. China agrees to buy more U.S. agricultural products. Farmers in the U.S. gain huge benefits. The U.S. allows partial tariff rollbacks on auto parts and batteries. China's EV and battery industry breathes again. New rules for transparency in supply chains, to avoid sudden export restrictions or political surprise moves. Tech restrictions remain, but are clarified. The U.S. keeps semiconductor limits, but offers clearer licensing rules. In short, a trade war didn't end, but it evolved into a controlled competition. Impact on global markets. Markets reacted instantly. Stock markets jumped globally. Tech, EVs, and manufacturing stocks rallied. Gold prices dipped slightly before stabilizing. Investors temporarily moved from safe havens to risk assets. Oil demand outlook improved. A stable supply chain means stronger industrial demand. Asian markets showed the strongest reaction. Hong Kong, Shanghai, Tokyo, and Seoul all surged. Impact on the average person. You may ask, how does this affect normal people? Here's how. Cheaper electronics, phone, laptop, and appliance prices could drop by 3 to 8%. Lower inflation pressure. Reduced tariffs equals reduced import costs, more manufacturing jobs. Companies get clarity, so they invest more. Better global shipping times, less tension equals smoother supply chains. Who benefited more? USA versus China. Every deal has a winner, but this one has two different victories. USA's wins: more agricultural exports, stronger technology control, lower inflation pressure, stabilized supply chains for American companies. China's wins: tariff relief for EVs, batteries, and machinery, reopening access to U.S. high-value markets, more predictable trade rules, stronger currency stability. But long-term, this deal gives both sides breathing room, while competition continues.